all major issues for the economy now and in the new year. We're getting both sides of the coin now. From former Biden administration Council of Economic Advisors Chair Jared Bernstein, he's now a fellow at the Stanford Institute for Economic Policy Research, and Peter Earle, senior economist at the American Institute for Economic Research, and cousin of Steve Earle, the guitarist. No,
not unfortunately.
Let me start with, I guess, Jared. Jared, 4.3% GDP number. According to Howard Lutnick, the Commerce Secretary, means you're all going to get 4.3% wages. We know that not to be true. However, it's a good number, and it's a better number than perhaps many expected, given the disruption that was expected from, for example, the tariff policies and some of the other policies of the Trump administration. How do you respond to that?
Well, it was much better than expected, a full point. And the consumer just keeps on plowing along. And investment, of course, has been pretty strong. It weakened a bit over the quarter, but AI investment continues to help the economy plow ahead. And the American consumer, as unhappy as he and she say they are, has been relentless. Look, there are risks to the outlook. The labor market has weakened. And in fact, we've seen wage growth slow, particularly for folks in the bottom half. And if you talk to businesses, they will tell you that most of the spending has been driven by folks at the top. So there's this K-shaped story that I believe is pretty accurate. But you're talking aggregate numbers, and in the aggregate, consumer spending and investment has been strong. Of course, there's probably some government fiscal oomph coming, a punch there from tax cuts coming next year. So the forecasts are for growth to continue to be moderate, if not better than moderate.
So are you admitting the policies aren't that bad?
Well, I never said they were that bad. I think the policy in particular that has been extremely problematic is tariffs. And yes, I maintain that the tariffs are hugely problematic, but they certainly haven't stopped the economy from growing. And I've written extensively about that. Same with the negative vibes. I mean, the gap between how consumers feel and what consumers do, again, in the aggregate is real. But the tariffs have made life more expensive for people. It's not a coincidence that affordability is a huge issue. Healthcare, childcare, housing, electricity costs, groceries, all of those remain highly problematic for consumers. But there's a difference between how people feel and these aggregate indicators.
Not Peter is what I want to say. Peter Earle.
You're Steve.
No, Steve Earle is to my brain this morning. But my problem with these policies is not even the individual ones. Could be okay with an immigration policy the way it is, or okay with the tariff policy the way it is. It's figuring out how they all interact, and they all do interact. And when you put them all in the pot, it's a stew that's kind of difficult to figure out what the heck is going on here. So when you think about, for example, this idea of AI coming in and it's going to cut some jobs, but we also have this immigration policy out there that could actually lift up jobs. How do you put it all together and spin out a forecast for next year?
Well, what we do is we try to think of a couple of things. First of all, the lag effects, meaning how long they take to get into action, how long they take to hit the economy. We try to think about which may supersede others, those that are on, say, a federal level versus those that are a little more patchwork, like where and how AI will enter private business. And then, a little bit of it is also historical precedent. What happens when we have, structural technological change hitting cyclical forces? So, I mean, it's a hazardous business forecasting, but it's what we get paid to do. And every forecast has us sort of hanging out there waiting to be exposed.
What do you come up with, Peter? What do you come up with for next year?
Well, for next year, what I think is we're going to have continued GDP growth. I think, as Jared said, consumer spending is resilient, but it's uneven. I think we're going to see investment broaden behind or rather beyond the AI leaders. As financial conditions ease, uncertainty diminishes. We've got a couple of different sources of fiscal stimulus. I think the ingredients are in place for investment to broaden beyond the very narrow group of AI names. And so for that reason, I think that capital spending is likely to become a growth engine next year. And that is if it can overcome, as you just mentioned, there's other forces. If it can overcome, the kind of slowdown we're seeing in employment, which Fed easing may assuage.